Chapter 2, Managerial Accounting and Cost Concepts. In this lecture, we will talk about the differences and similarities between financial and managerial accounting, and also explain how managers need to rely upon different classifications of costs for different purposes. The four main purposes emphasized in this lecture include preparing external financial reports, predicting cost behavior, assigning costs to cost objects, and making business decisions. Managers carry out three main activities: planning, directing, motivating, and controlling. An important part of planning is to identify alternatives and then to select from among the alternatives the one that does the best job of furthering the organization's objectives. Once alternatives have been identified, the plans of management are often expressed formally in budgets. Budgets are usually prepared under the direction of the controller, who is the manager in charge of the accounting department. Typically, budgets are prepared annually. In addition to planning for the future, managers must oversee day-to-day activities to keep the organization functioning smoothly. Managerial accounting data such as daily sales reports are often used in this type of day-to-day decision-making. In carrying out the control function, managers seek to ensure that the plan is being followed. Feedback, which signals whether operations are on track, is the key to effective control. A performance report compares budgeted to actual results. It suggests where operations are not proceeding as planned and where some parts of the organization may require additional attention. The work of management, which is known as the planning and control cycle, can be depicted as shown here. The process is a continuous loop in many organizations. Once plans are made, they are implemented. The controlling process starts with measuring actual performance and then comparing those results with planned performance. Corrective action may be necessary if actual results differ significantly from the plan. In some cases, new information may result in altering the plan before the cycle is repeated. Note that decision-making is involved in all management activities. So let's do learning objective number 1, which is to identify the major differences and similarities between financial and managerial accounting. There are 7 key differences between managerial accounting and financial accounting. The users are different. Financial accounting reports are prepared for external parties, whereas managerial accounting reports are prepared for internal users. Number 2, the emphasis is on the future. Financial accounting summarizes the past transactions. Managerial accounting has a strong future orientation. Number 3, relevance of data. Financial accounting data should be objective and verifiable. Managerial accountants focus on providing relevant data even if these data are not completely objective and verifiable. 4, less emphasis on precision. Financial accounting focuses on precision when reporting to external parties. Managerial accounting aids decision makers by providing good estimates as soon as possible rather than waiting for precise data later. Segments of an organization. Here, financial accounting is concerned with reporting for the company as a whole. Managerial accounting focuses more on the segments of the company. Examples of segments include product lines, sales territories, divisions, departments, etc. 6, GAAP, generally accepted accounting principles. Financial accounting conforms to GAAP. Managerial accounting is not bound by GAAP. And 7th, managerial accounting is not mandatory. Financial accounting is mandatory because various outside parties require periodic financial statements. Managerial accounting is not mandatory. Learning objective number 2 is to identify and give examples of each of the 3 basic manufacturing cost categories. Manufacturing costs are usually grouped into 3 main categories: direct materials, direct labor, and manufacturing overhead. These costs are incurred to make a product. Direct materials are raw materials that become an integral part of the finished product and whose costs can be conveniently traced to it. Examples include the aircraft engines on a Boeing 777, the Intel processing chip in a personal computer, the blank video cassette in a pre-recorded video, and a radio in an automobile. Direct labor consists of that portion of labor costs that can be easily traced to a product. Direct labor is sometimes referred to as touch labor, since it consists of the costs of workers who touch the product as it is being made. Manufacturing overhead includes all manufacturing costs except direct materials and direct labor. These costs cannot be easily traced to specific units produced, also called indirect manufacturing cost, factory overhead, and factory burden. Manufacturing overhead includes indirect materials that are part of the finished product but that cannot easily be traced to it. It includes indirect labor costs that cannot be conveniently traced to the creation of the products. And other examples of manufacturing overhead include maintenance and repairs on production equipment, heat and light, property taxes, depreciation, and insurance on manufacturing facilities. A manufacturing company incurs many other costs in addition to manufacturing costs. For financial reporting purposes, most of these costs are typically classified as selling costs and administrative costs. These costs are also called selling, general and administrative costs, or SG&A. Selling and administrative costs are incurred in both manufacturing and merchandising firms. Selling costs include all costs necessary to secure customer orders and get the finished product into the hands of the customer. These costs are also referred to as order getting and order filling costs. Examples of selling costs include advertising, shipping, sales travel, sales commissions, sales salaries, and cost of goods in finished warehouses. Administrative costs include all executive, organizational, and clerical costs associated with the general management of the organization. Examples of administrative costs include executive compensation, general accounting, secretarial, public relations, and similar costs involved in the overall general administration of the organization as a whole. Learning objective number 3. Let's distinguish between product costs and period costs and give examples of each. Costs can also be classified as product or period costs. Product costs include all the costs that are involved in acquiring or making a product. More specifically, it includes direct materials, direct labor, and manufacturing overhead. Consistent with the matching principle, product costs are recognized as expenses when the products are sold. This can result in a delay of one or more periods between the time in which the cost is incurred and when it appears as an expense on the income statement. Product costs are also known as inventoriable costs. The discussion here follows the usual interpretation of GAAP, in which all manufacturing costs are treated as product costs. Period costs include all selling costs and administrative costs. These costs are expensed on the income statement in the period incurred. All selling and administrative costs are typically considered to be period costs. The usual rules of accrual accounting apply to period costs. So, for example, administrative salary costs are incurred when they are earned by the employees and not necessarily when they are paid to the employees. So let's check our knowledge. Which of the following costs would be considered a period cost rather than a product cost in a manufacturing company? Property taxes on corporate headquarters and sales commissions. Two more cost categories are often used in discussions of manufacturing costs: prime cost and conversion cost. Prime cost is the sum of direct material cost and direct labor cost. Conversion cost is the sum of direct labor cost and manufacturing overhead cost. So the term conversion cost is used to describe direct labor and manufacturing overhead because these costs are incurred to convert materials into the finished product. Merchandising companies purchase finished goods from suppliers for resale to customers. Manufacturing companies purchase raw materials from suppliers and produce and sell finished goods to customers. Now, let's consider similarities and differences on the balance sheet for merchandising and manufacturing companies. Both merchandising and manufacturing companies will likely have cash and receivables. However, merchandising companies do not have to distinguish between raw materials, work in process, and finished goods. They report one inventory number on their balance sheets labeled merchandise inventory. Manufacturing companies report three types of inventory on their balance sheets: raw materials, work in process, and finished goods. Raw materials are the materials used to make the product. Work in process consists of units of product that are partially complete but will require further work to be sellable to customers. Finished goods consist of units of product that have been completed but not yet sold to customers. Learning objective number 4. Let's prepare an income statement including the calculation of the cost of goods sold. Merchandising companies calculate costs of goods sold as beginning merchandising inventory plus purchases minus ending merchandise inventory. For manufacturing companies, the cost of goods sold for a period is not simply the manufacturing costs incurred during the period. Manufacturing companies calculate cost of goods sold as beginning finished goods inventory plus cost of goods manufactured minus ending finished goods inventory. Some of the cost of goods sold may be for units completed in a previous period, and some of the units completed in the current period may not have been sold and will still be on the balance sheet as assets. The cost of goods sold is computed with the aid of a schedule of costs of goods manufactured, which takes into account changes in inventories. A schedule of costs of goods manufactured is not ordinarily included in external financial reports, but must be compiled by accountants within the company in order to arrive at the cost of goods sold. We'll talk more about the schedule of costs of goods manufactured a little later. The computation of costs of goods sold relies on this basic equation for inventory accounts. The logic underlying this equation applies to any inventory account. Any units that are in inventory at the beginning of the period appear as the beginning balance. During the period, additions are made to the inventory through purchases and other means. The sum of the beginning balance and the additions to the account is the total amount of inventory available. During the period, withdrawals are made from inventory. The ending inventory is whatever is left at the end of the period after withdrawals. So let's check. If your inventory balance at the beginning of the month was $1,000, you bought $100 during the month and sold $300 during the month, what would be the balance at the end of the month? And there you have it, $800. Learning objective number 5. Let's prepare a schedule of costs of goods manufactured. The schedule of goods manufactured contains the 3 elements of costs mentioned previously, namely direct materials, direct labor, and manufacturing overhead. It calculates the cost of raw material, direct labor, and manufacturing overhead used in production. It also calculates the manufacturing costs associated with goods that were finished during the period. To create a schedule of cost of goods manufactured as well as a balance sheet and income statement, it is important to understand the flow of product costs. Raw material purchases made during the period are added to beginning raw materials inventory. The ending raw materials inventory is deducted to arrive at the raw materials used in the production. As items are removed from raw materials inventory and placed into the production process, they are also called direct materials. Direct labor and manufacturing overhead are also called conversion costs used in production, and these are added to direct materials to arrive at total manufacturing costs. Total manufacturing costs are added to the beginning work in process to arrive at total work in process. The ending work in process inventory is deducted from the total work in process for the period to arrive at the total cost of goods manufactured. The cost of goods manufactured is added to the beginning finished goods inventory to arrive at cost of goods available for sale. The ending finished goods inventory is deducted from this figure to arrive at cost of goods sold. All raw materials, work in process, and unsold finished goods at the end of the period are shown as inventoriable costs in the asset section of the balance sheet. As finished goods are sold, their costs are transferred to cost of goods sold in the income statement. Selling and administrative expenses are not involved in making the product. Therefore, they are treated as period costs and reported in the income statement as the period for the period the cost is incurred. So let's check. Beginning raw materials inventory was $32,000. During the month, $276,000 of raw material was purchased. That account at the end of the month revealed that $28,000 of raw material was still present. What is the cost of direct material used? $280,000. Even though the circle is on B, it should be C. Direct materials used in production total $280,000. Direct labor was $375,000 and factory overhead was $180,000. What were total manufacturing costs incurred for the month? $835,000. Beginning work in process was $125,000. Manufacturing costs incurred for the month were $835,000. There were $200,000 of partially finished goods remaining in work in process inventory at the end of the month. What was the cost of goods manufactured during the month? $760,000. Beginning finished goods inventory was $130,000. The cost of goods manufactured for the month was $760,000, and the ending finished goods inventory was $150,000. What was the cost of goods sold for the month? $740,000. Okay. Learning objective number 6. Let's understand the differences between variable costs and fixed costs. Quite frequently, it is necessary to predict how a certain cost will behave in response to a change in activity. For example, a manager may want to estimate the impact that a 5% increase in sales would have on the company's total electric bill. Cost behavior refers to how a cost will react to changes in the level of activity within the relevant range. The most commonly used classifications of cost behavior are variable and fixed costs. A variable cost varies in direct proportion to changes in the level of activity. For example, if you don't have a texting plan on your cell phone and text messaging costs 5 cents per unit, your total texting bill increases the number of texts you send. Although variable costs change in total as the activity level rises and falls, variable cost per unit is constant. So, for example, the cost per text message is constant at 5 cents per text. A fixed cost is constant within the relevant range. In other words, fixed costs do not change for changes in activity that fall within the relevant range. The operative word is relevant range. For example, your monthly contract fee for your cell phone is a fixed amount for a certain number of minutes. The monthly contract fee does not change based on the number of calls you make. Of course, if you go over your monthly minutes allotment, you have exceeded the relevant range for your monthly contract and will be charged above and beyond your monthly contract fee. However, when expressed on a per unit basis, a fixed cost is inversely related to activity. The per unit cost decreases when activity rises and increases when activity falls. For example, the average fixed cost per cell phone call decreases as more calls are made in the month. It's helpful to think about variable and fixed cost behavior in the 2x2 matrix shown here. Take a few minutes and review this cost summary for variable and fixed costs. Which of the following costs would be variable with respect to the number of cones sold at a Baskin & Robbins ice cream shop? There could be more than one answer. The cost of ice cream and the cost of napkins for customers. Learning objective number 7 is to understand the differences between direct and indirect costs. A cost object is anything for which cost data are desired, including products, customers, jobs, organizational subunits. For purposes of assigning costs to cost objects, costs are classified two ways. 1. Direct costs are costs that can be easily and conveniently traced to a specific cost object. Examples of direct costs are direct material and direct labor. Indirect costs are costs that cannot be easily and conveniently traced to a specified cost object. An example of an indirect cost is manufacturing overhead. Common costs are indirect costs incurred to support a number of cost objects. These costs cannot be traced to any individual cost object. Learning objective number 8 is to define and give examples of cost classifications used in making decisions. Differential costs, opportunity costs, and sunk costs. It is important to realize that every decision involves a choice between at least two alternatives. The goal of making decisions is to identify those costs that are either relevant or irrelevant to the decision. Costs and benefits that differ between alternatives are relevant in a decision. All other costs and benefits are irrelevant and can and should be ignored. To make decisions, it is essential to have a grasp on three concepts: differential costs, opportunity costs, and sunk costs. Differential costs, or incremental costs, is the difference in cost between two alternatives. Differential costs can be either fixed or variable. A difference in revenue between two alternatives is called differential revenue. For example, assume you have a job paying $1,500 per month in your hometown. You have a job offer in a neighboring city that pays $2,000 per month. The commuting cost to the city is $300 per month. So in this example, the differential revenue is $500 and the differential cost is $300. Opportunity cost is the potential benefit that is given up when one alternative is selected over another. These costs are not usually entered into the accounting records of an organization, but must be explicitly considered in all decisions. A sunk cost is a cost that has already been incurred and that cannot be changed by any decision made now or in the future. Since sunk costs cannot be changed and therefore cannot be differential costs, they should be ignored in decision making. While students usually accept the idea that sunk costs should be ignored on an abstract level, like most people, they often have difficulty putting this idea into practice. So let's do a quick check. The basic question is, should the cost of a train ticket affect the decision of whether you drive or take the train? And in this example, suppose we are trying to decide whether to drive or take the train to Kuala Lumpur or to Portland, any place, to attend a concert. You have plenty of cash to do either, but you don't want to waste money needlessly. Is the cost of train ticket relevant in this decision? In other words, should the cost of the train ticket affect the decision on whether you drive or take the train? Yes, the cost of the train ticket is relevant. Now, suppose you're trying to decide whether to drive or take the train. Is the annual cost of licensing your car relevant in this decision? Probably no, because the licensing cost is not relevant. Suppose that your car could be sold now for $5,000. Is this a sunk cost? No, it's not a sunk cost. We have looked at the cost classifications used for financial reporting, predicting cost behavior, assigning cost to cost objects, and making business decisions. Now let's look at how to classify idle time, overtime, and fringe benefits. So, learning objective number 9. Properly account for labor costs associated with idle time, overtime, and fringe benefits. Machine breakdowns, material shortages, power failures, and the like result in idle time. The labor costs incurred during idle time are ordinarily treated as manufacturing overhead. This enables the cost to be spread across all the production rather than the units in process when the disruptions occur. The overtime premiums for all factory workers are usually considered to be part of manufacturing overhead. This is done to avoid penalizing particular products or customers' orders simply because they happen to fall on the tail end of the daily production schedule. Exceptions may be found in some Asian companies which consistently have overtime due to the urge of full utilization of available capacity and the shortage of workers. In those cases, they may have valid arguments to put overtime as part of the normal labor cost. Labor fringe benefit costs are employment-related costs paid by an employer, such as an insurance program, retirement plan, supplemental unemployment program. They also include the employer's share of Social Security and Medicare, workers' comp, federal employment tax, and state unemployment insurance. These costs often add up to 30 to 40% of an employee's base pay. Some companies include all of these costs in manufacturing overhead. Other companies opt for the conceptually superior method of treating fringe benefit expenses of direct laborers as additional direct labor costs. All right, cost of quality. Learning objective number 10. Identify the 4 types of quality costs and explain how they interact. The term quality has many meanings. Quality can mean that a product has many features not found in other products. It can mean that it is well designed, or it can mean that it is defect-free. And in this section, the focus is on the presence or absence of defects. Quality of conformance is the degree to which the actual product or service meets its design specifications. Anything that does not meet design specifications is a defect and is indicative of low quality of conformance. There are 4 broad categories of quality costs: prevention costs, appraisal costs, internal failure costs, and external failure costs. Prevention costs are incurred to support activities whose purpose is to reduce the number of defects. Appraisal costs are incurred to identify defective products before the products are shipped to customers. Internal failure costs are incurred as a result of identifying defects before they are shipped to customers. External failure costs are incurred as a result of defective products being delivered to customers. Here are some examples of each type of quality costs. Prevention costs include quality training, quality circles, and statistical process control activities. Appraisal costs include testing and inspection of incoming materials, final product testing, and depreciation of testing equipment. Internal failure costs include scrap, spoilage, and rework. External failure costs include the cost of field servicing and handling customer complaints, warranty repairs, and lost sales arising from reputation of poor quality. Graphs are often used to depict the relationship between the four types of quality costs. The graph on this slide illustrates four key concepts. First, when the quality of conformance is low, total quality cost is high, and most of this cost consists of internal and external failure costs. 2. Total quality costs drop rapidly as the quality of conformance increases. 3. Companies reduce their total quality costs by focusing their efforts on prevention and appraisal because the cost savings from reduced defects usually overwhelm the costs of additional prevention and appraisal. And 4. Total quality costs are minimized when the quality of conformance is slightly less than 100%. This is a debatable point in the sense that some experts believe that total quality costs are not minimized until the quality of conformance is 100%. So, learning objective number 11. Let's prepare and interpret a quality cost report. A quality cost report details the prevention, appraisal, internal failure, external failure costs that arise from a company's current quality control efforts. When interpreting a cost of quality report, managers should look for two trends. First, increases in prevention and appraisal costs should be more than offset by decreases in internal and external failure costs. Second, the total quality costs as a percent of sales should decrease. Quality cost reports can also be prepared in graphic form. Managers should look for the same two trends whether the data are presented in graphic or table format. Uses of quality cost information include the following. It helps managers see the financial significance of defects. It helps managers identify the relative importance of the quality problems faced by the company, and it helps managers see whether their quality costs are poorly distributed. So in general, costs should be distributed more toward prevention and to a lesser extent appraisal than towards failures. Limitations of quality cost information include the following. Simply measuring and reporting quality cost problems does not solve quality problems. Results usually lag behind quality improvement programs. Initially, prevention and appraisal cost increases may not be offset by decreases in failure costs. The most important quality cost, lost sales arising from customer ill will, is often omitted from quality cost reports because it is difficult to estimate. The International Organization for Standardization, based in Geneva, has established quality control guidelines known as ISO 9000 standards. For a company to be ISO 9000 certified by a certifying agency, it must demonstrate that, first, a quality control system is in use, and the system clearly defines an expected level of quality. Second, the system is fully operational and is backed with the detailed documentation of quality control procedures. And 3, the intended level of quality being achieved on a sustained basis. Although the ISO 9000 standards were developed in Europe, they have become widely accepted elsewhere throughout the world, including the United States and Asia.